21st century, and I couldn't be more pleased. So this hearing will come to order. And I do want to, first of all, congratulate our colleague and ranking member, Senator Gallego. He is at home today with brand new baby Cooper, and we wish you the very best with you and your new son, Senator Gallego. I know that you are deeply engaged in the discussion on market structure and will be submitting questions for the record. So again, our congratulations to you. I also want to congratulate Senators Hagerty, Chairman Scott, Senator Gillibrand, and also Brooks, and members of this subcommittee on the passage of the Genius Act last week. It really was a historic moment for digital asset regulation. It was a bumpy ride getting it done, but all the sweeter for that. And we showed that we can use regular order and bipartisanship to get things done around here, regardless of how arduous that may be. So we don't want to lose momentum. Today's hearing is going to focus on the need for digital asset market structure legislation and the themes that the Senate Banking Committee will need to consider in the coming weeks. So to avoid some of the bumpiness that we experienced in getting through the process with stablecoins, we're going to start the market structure component of digital asset regulation with some general guidelines and principles governing the committee's consideration of bipartisan market structure legislation. So we released those principles this morning. They were signed by Chairman Scott, Tillis, Hagerty, and myself. And these principles include the following. Legislation should clearly define the legal status of digital assets, meaning that Congress should draw the line between a security and a commodity in statute. That has been a clear source of frustration for those who are attempting to identify their regulator. Second, jurisdiction should be clearly allocated among regulators, including that all digital assets and distributed ledger technology should not be regulated equally, but that different opportunities and risks come with different assets and forms of this technology. And I invite you all to provide guidance based on your experience in this particular area. Third, regulation should be modernized to foster innovation, including a new securities registration pathway for digital asset fundraising and modernization, so we can have existing rules brought up to date with respect to custody and record keeping to account for the efficiency and transparency of distributed ledger technology. Fourth, regulation should protect consumers, including requiring digital asset exchanges to be subject to comparable regulation as other centralized intermediaries, and that customers should have priority in bankruptcy. Fifth, illicit finance measures should be targeted and pro-innovation. This has been an area that has vexed me, trying to understand where some of the people on the Intel Committee are coming from. But I think I'm getting a clear picture because I got to spend a lot of time with them as we were negotiating stablecoins. So this would require adopting digital asset examination standards and considering the extent to which distributed ledger technology can improve the work of law enforcement. And finally, financial regulators should welcome responsible innovation and promote the use of no-action letters, sandboxes, regulatory coordination, and appropriate timelines for application decisions. This industry over the last 4 years has been embroiled in very expensive litigation that provided no clear path forward for complying with regulations and being innovative in the process. So that's our goal. And I look forward to working with Ranking Member Gallego, the members of the subcommittee, Chairman Scott, and Chairman Bozeman, who of course has jurisdiction over the Commodity Futures Trading Commission, because we want to move market structure forward. And today we have a very distinguished panel of witnesses, and I am grateful that you are here. Sarah Hammer is the Executive Director of the University of Pennsylvania's Wharton School. Greg Xethalis, General Counsel of Multicoin Capital. Ryan VanGrack, Vice President of Legal at Coinbase, and the Honorable Russ Behnam, former chair of the Commodity Futures Trading Commission and a distinguished fellow at Georgetown University. Welcome and thank you to each of you. So, without further ado, Ms. Hammer, you are recognized for your opening remarks.
Thank you. Chair Lummis, Ranking Member Gallego, and members of the subcommittee, thank you for the opportunity to testify on this pivotal issue for the future of American financial leadership. Your dedication comes at a critical moment as the U.S. stands at a crossroads in shaping the next generation of financial services. I am Sarah Hammer, Executive Director at the Wharton School, founder and CEO of Wharton Cipher Accelerator, an adjunct professor at the University of Pennsylvania Law School. I previously served as acting Deputy Assistant Secretary for Financial Institutions at the U.S. Treasury and acting Secretary of Banking and Securities for the Commonwealth of Pennsylvania during the 2023 banking crisis. Additionally, I have held roles in portfolio analytics, macroeconomic research, trading, portfolio management, investment strategy, and institutional asset management. I have more than 25 years of experience in finance, law, and technology. Before I begin, I would like to note that today's testimony reflects my personal views and does not necessarily reflect the views of the Wharton School or the University of Pennsylvania. I will draw upon extensive research, analysis, and professional experience to assess the U.S.'s position in the global digital asset landscape and to outline the strategic steps necessary to sustain and strengthen our leadership. To begin my research, I conducted a temporal analysis of proprietary, geographically tagged data on stablecoin transfers, active digital wallet addresses, and blockchain transactions. Across all categories, the data shows that while North America led the digital asset landscape in 2021 and 2022, by 2025, Europe has nearly closed the gap and is now poised to surpass us. Notably, the 2023 passage of the EU's Markets in Crypto Assets regulation did not suppress activity. On the contrary, it appears to have potentially accelerated it, reinforcing the importance of regulatory clarity as a catalyst for vibrant digital asset markets. I also conducted a global assessment of digital asset regulatory frameworks. Since as early as 2018, jurisdictions including Bermuda, Singapore, Switzerland, Dubai, and the European Union have established comprehensive legal regimes. Today, approximately 50 countries have either enacted or are actively developing digital asset frameworks. These jurisdictions recognize a fundamental point. Regulatory clarity does not hinder innovation, it enables it. The question now is how the United States will lead. In my 2022 paper, A Comprehensive Approach to Crypto Regulation, I set forth 3 foundational principles for effective digital asset oversight. First, clear standards, rules, and enforcement mechanisms. Second, robust consumer protections. And third, leadership in global standard setting. This principles-based approach provides a strategic blueprint for balancing responsible innovation with market integrity and financial resilience. Additionally, my assessment of foreign jurisdictions offers insights that can inform the development of a bold and enduring U.S. regulatory framework. A foundational pillar of a comprehensive digital asset framework is a clear and coherent taxonomy, codified by statute and tailored to the complexity of this evolving market. Other essential pillars include a streamlined supervisory structure, appropriate regulation for stablecoins, market integrity provisions to prevent crime, manipulation, and systemic risk, and a bankruptcy regime. Equally critical are provisions that foster innovation and active engagement, securing America's role at the helm of financial leadership. Blockchain and digital assets are reshaping the global financial system in real time. While international models offer valuable lessons, the United States will chart its own course, guided by principles, driven by innovation, and anchored in our leadership. This is how America will marshal the future of finance. Thank you.
Thank you, and I look forward to exploring more with you of your remarks. And now I would like to ask Mr. Xethalis for your opening remarks.
Thank you, Chair Lummis, Ranking Member Gallego, and members of the subcommittee. I want to thank you for the opportunity to testify today in my personal capacity. My name is Greg Xethalis, and I am the General Counsel of Multicoin Capital, a registered investment advisor focused on the digital asset ecosystem. I also serve as a director of both the Blockchain Association and the DeFi Education Foundation, and I teach at Duke University School of Law, where I've had the privilege of helping train the next generation of financial regulatory attorneys. Multicoin invests in both liquid assets and early-stage venture. Through that work, we support founders who are building the future of financial infrastructure and internet-native commerce. But increasingly, those founders are not building in the United States. They're setting up abroad, not because they want to avoid rules, but because the rules here are often opaque, fragmented, or even contradictory. That is not a sustainable outcome. The 119th Congress has the opportunity to reverse that trend, and I want to begin by commending this committee and your counterparts on agriculture and in the House for advancing bipartisan proposals that aim to bring clarity, structure, and accountability to this industry. The House's Clarity Act and the Senate's prior iterations of the Responsible Financial Innovation Act are serious, thoughtful proposals, as are the market structure principles released by members of this committee earlier this morning. The House and Senate proposals are not competing. They're complementary. Together, they provide a framework for regulating centralized intermediaries, as well as two essential ingredients in understanding the taxonomy of digital assets. First, a maturity test grounded in decentralization and functionality that helps determine when a token no longer relies on the efforts of an identifiable third party. Second, a legal recognition that a token offered in an investment contract is not itself a security. It's the transaction and the context of that transaction that matters. This is important. The current state of affairs, where almost every digital asset transaction is subject to second guessing and nearly all innovation has been met with enforcement threats, that has produced a chilling effect. Entrepreneurs face the risk of building into a legal gray zone, and established institutions like banks, corporations, and exchanges are sitting on the sidelines, afraid to touch new important technologies. As a venture investor, I want to be very clear. The industry and our founders are not asking for a free-for-all. To the contrary, we are asking for regulation that is fair, functional, and intelligible. Today's environment imposes an invisible tax on innovators, compliance costs that scale not with the complexity of a product, but with the ambiguity of the law itself. And while we debate clarity here at home, other countries, as Sarah mentioned, are moving forward. The European Union passed MiCA, the UAE, Singapore, the UK, Switzerland, and Hong Kong are all establishing bespoke licensing regimes and stablecoin oversight. According to the 2024 Electric Capital Developers Report, the US share of global blockchain developers dropped from 42% in 2018 to just 24% last year. That is a striking decline in a sector where developers are the leading indicators of future company formation and capital investment. At the same time, we also need to preserve the mechanisms that enable permissionless innovation. Self-custody and decentralized finance, or DeFi, are not edge use cases. They are how every new token and protocol begins. Centralized intermediaries only support an asset or a protocol after there's proven demand measured by usage, liquidity, and community support. Without DeFi and self-custody, we lose the sandbox that allows innovation to flourish. And without preserving legal space for these tools, we push early-stage projects entirely outside the reach of US regulatory oversight and our country's commercial norms. We also need a principles-based approach. Regulation should define the outcomes we want, namely transparency, disclosure, and consumer protection, but it should not mandate that today's business models are the forever business models. This market evolves quickly. In the last 5 years, we've seen radical improvements in how protocols launch, govern themselves, and deliver value. We need legislation that can accommodate the future, not lock us in the past. Finally, let me emphasize, clarity is not the enemy of regulation or innovation. It is the foundation. Clear rules empower responsible builders. Clear standards allow users and investors to make informed choices, and clarity enables enforcement to be more targeted and effective and just. The United States has always led global financial markets, not by closing doors to innovation, but by setting the rules of the road. And this is a defining moment for this committee to do the same for digital assets. Thank you for your leadership, and I look forward to your questions.
Xethalis, we're so pleased you're here. And I want to reiterate the same to Ryan VanGrack, who is the Vice President of Legal at Coinbase, and you are recognized for your opening remarks.
Thank you, Senator. Good afternoon, Chair Lummis and members of the subcommittee. Thank you for the opportunity to appear before you today. My name is Ryan VanGrack, and I am Vice President of Legal at Coinbase, the largest digital asset exchange in the country. It is an honor to speak to you about the growing and urgent need for regulatory clarity in the digital asset industry. Today, more than 52 million Americans, that's 1 in 5 adults, own digital assets, including stablecoins and digital commodities like Bitcoin. Globally, these markets exceed $3 trillion in value. But Congress now stands at a crossroads. It can pass comprehensive market structure legislation as soon as possible, or it can risk losing the momentum forged through months of bipartisan collaboration. By passing the Genius Act, the Senate has shown it is up to the task. And while we applaud and strongly support that bill, stable coins are only one piece of the puzzle. Congress cannot leave market structure legislation behind. As detailed in my written testimony, we are at a generational inflection point. We have the opportunity to deliver a clear, uniform, and simple legal framework for digital assets. And if we get this right, we don't just regulate these markets. We will have unlocked their full potential to drive innovation, inclusion, and economic growth. Allow me to flag a few key points. First, American leadership in digital assets is at stake. To position the US as the epicenter of crypto innovation and capture the full promise of digital assets, we must unite and deliver the durable legal certainty that only legislation can provide. Without that, regulatory gaps give bad actors room to exploit the system, putting customers at risk and eroding public trust. Meanwhile, responsible innovators are left navigating the legal uncertainty, which drives talent and capital abroad and undermines US leadership in financial markets. We can and must do better. The risk of inaction dwarfs the risk of taking action. Second, this isn't just about fostering innovation, it's about protecting customers. Blockchain technology is already transforming lives. enabling faster, cheaper cross-border payments, strengthening identity verification, and driving the democratization and modernization of global finance. Yet today, Americans face a fragmented regulatory landscape, a patchwork of overlapping and often conflicting assertions of state and federal authority. The result? Customers lack consistent, comprehensive protections. No other financial market of this scale is plagued by such uncertainty. Americans deserve clear, uniform, and simple federal safeguards no matter where they live. The good news, Senator, is that Congress has the blueprint, the consensus, and the authority to act now. Thankfully, we're not starting from scratch. Both chambers have made critical progress on crypto legislation with strong bipartisan support. And there is growing alignment on key principles, including that the CFTC should oversee spot markets, that not all transactions involving digital assets are securities, and that token issuers need clear, workable paths to compliance. Legislation isn't just possible, it's within reach. In closing, innovation and customer protection are not mutually exclusive. Far from it. Clear, comprehensive rules can both promote American innovation and protect American consumers while ensuring that America shapes the future of global finance. The opportunity is clear and the urgency is real. Now is the moment to deliver for the American people. Thank you, and I look forward to taking your questions.
Thank you, Mr. VanGrack. And last but certainly not least, the Honorable Russ Behnam, former chair of the Commodity Futures Trading Commission. It's great to see you again, and we welcome your opening remarks.
Thank you, Senator. Great to see you as well. Chair Lummis, Ranking Member Gallego, members of the Digital Assets Subcommittee, I'm honored to testify before you today on this important topic. Between 2017 and 2025, I served first as a commissioner, then the chair of the CFTC. During that 7-year period, I observed the significant growth of the digital asset market. While I served at the CFTC, the digital asset market endured multiple periods of dramatic volatility. Throughout this time, I publicly stated one consistent message to Congress. Under current U.S. law, there is a gap in regulation for the non-security digital asset market. The regulatory gap remains today and must be filled with targeted legislation. It has facilitated countless scandals and fraudulent activity, some very small and typical in criminal form, others massive in scale and profile. Further, based on my current observations and those while at the CFTC, I do not believe public interest for digital assets will wane. Inaction will only result in greater risk to our financial markets and those investors that participate in them through a lack of market transparency, fraud, market manipulation, corruption, and conflicts of interest. One common refrain in connection with past legislative efforts to fill this non-security gap suggests that a U.S. regulatory framework will legitimize the digital asset market, leaving opportunities for bad actors and industry players to capitalize on regulatory loopholes and unwitting retail investors. I believe this argument is the loophole. It has only left the vast majority of the digital asset market unregulated and investors vulnerable to fraud and manipulation. I believe it's critical to anchor digital asset market structure legislation in the following. First, durable legal precedent to define tokens as securities or commodities. And second, current securities and commodity derivatives market structure as the model for digital asset market structure. Market structure in traditional finance has evolved over many decades. I urge the committee to carefully examine how current unregulated digital asset market structure differs from traditional financial market structure, and consider where there may be opportunities for change and where existing market structure requirements should be preserved. The CFTC and SEC have a long-standing partnership that facilitates strong, robust regulation of securities and commodity derivatives markets. In a situation where a regulated entity handles both security and non-security tokens in the underlying market, separate and exclusive jurisdiction for the CFTC and the SEC is critical to a healthy, comprehensively regulated ecosystem. As the committee explores legislative solutions, I would like to focus attention on the components of a regulatory framework that would ensure U.S. market regulators have the tools to provide customer and market protections. The CFTC's principles-based oversight model has served its regulated markets well, striking an appropriate balance between clear, outcomes-based requirements and measured flexibility to meet those outcomes. Second, appropriate funding, which includes technology and human capital, is necessary to meet the mandate of any regulatory program. Third, a reliable self-regulatory organization like FINRA and the National Futures Association have been critical to the success of both the CFTC and the SEC for decades. Fourth, it's essential that legislation provide comprehensive authority for anti-money laundering, know your customer, and a customer identification program built off of existing requirements for market participants. Fifth, given the broad adoption of digital assets by a significant portion of the American population, a disclosure regime tailored to the underlying asset and a comprehensive education and outreach program will enable the investing public to understand both the risks and opportunities of this technology. Separately, and as was mentioned by my colleagues, the current divide between the U.S. and our international counterparts creates regulatory arbitrage opportunities that are exploited by bad actors and prohibits the U.S. from contributing in a positive way to much-needed multilateral coordination efforts. And finally, I encourage this committee, as it deliberates a digital asset regulatory framework, to ensure state and local law enforcement remain a key partner in fraud prevention. The principles and regulatory foundations that make U.S. capital markets and derivatives markets the deepest, most liquid, and most resilient in the world provide an effective model for digital asset market structure. We need to act thoughtfully, but with urgency, to fill this harmful regulatory gap in order to give American investors the protections they deserve. I thank the chair, ranking member, and members of the committee for your focus in this area and look forward to answering your questions. Thank you.
Well, I thank you, panel. We will have other members coming and going. I got a note from Mr. Marino that he is speaking on behalf of another member on the floor, but will be back shortly. And so I will take the liberty of having some extra time to ask you the myriad of questions that I've been dying to ask. And I'm going to start with fraud prevention, and I'd like to pose this question to both Mr. Behnam and Ms. Hammer. As we in the United States continue to have a lack of clarity with regard to our regulatory framework, are we inviting fraudulent actors away from jurisdictions that have more regulatory clarity? Ms. Hammer, do you have a thought on that?
Yeah, thank you so much, Chair Lummis. Again, thank you for the opportunity to be here today, and I appreciate that question greatly. I do think by not enacting a regulatory framework that the United States does leave the door open for fraudulent activity. And as I mentioned earlier in my testimony, I believe that a regulatory framework can enhance and enable innovation, and it can enhance and enable responsible innovation. So a couple of other thoughts on that. One is that, as I'll speak to, and as is found in my written testimony, the other jurisdictions that I have studied that have enacted comprehensive digital asset frameworks have placed a great emphasis on fraud prevention, clarity of compliance obligations, anti-money laundering requirements, and anti-terrorist financing requirements. And in doing so, they have made it clear and enabled organizations to better comply with their regulatory frameworks. I feel that that is an essential component of the regulatory framework here in the U.S. The second thing is engagement in the international standard-setting community. And by that, I mean the United States leadership in the international community. That coordination and collaboration across the globe is critical to fraud prevention anti-crime, anti-money laundering, and anti-terrorist financing. I believe strongly that the United States can take a great step forward by enacting a framework that clarifies obligations, that makes it clear to organizations what is required, and can provide leadership in the international community in this space. Thank you.
Before I could get to you, Mr. Behnam, I want to follow up with Ms. Hammer. Which country has the best anti-terrorist financing language?
Thank you very much for that question, Senator. There are several countries that have anti-terrorist financing language. Each country, as I noted in my written testimony, has tailored its regulatory framework to its own principles and its own values, and ultimately the United States will need to do the same. And that is how we will provide leadership.
Is there any country that you've looked at that said, wow, that's as close as the United States should get to accurate language?
Thank you, Senator. I feel that there are several jurisdictions that we could look to for lessons. I would say that the Singaporean framework makes it very clear what compliance obligations are. And it does that with the stated express purpose of anti-crime, anti-fraud, anti-money laundering, and anti-terrorist financing. And while no regulatory framework is perfect, I do think that there is a lesson there for the United States in terms of clearly setting forth what is required and strongly stating what companies must do in order to keep to adhere to our standards and principles on that issue.
Okay, thank you very much. Mr. Behnam?
Thanks, Senator. You know, so much of what I want to respond to echoes what Ms. Hammer said, and there are different components of fraud in a market landscape. There's obviously what you just heard around anti-money laundering, knowing your customer, illicit activity, anti-terrorist activity. A lot of the entities are regulated at the state level. A lot of the entities are regulated by the Treasury Department through FinCEN. But we're here today to discuss market structure regulation. And so much of what I advocated for when I was chair of the CFTC was driven by my experience and the experience of both the agency itself and the SEC with the enforcement program around fraud and manipulation in markets. And ultimately, I think bad actors will gravitate towards areas that are unregulated, where they know they can get away with conduct that does not have a legal framework around it. And as I said in my written testimony, market structure is not terribly complex when you think about it from a principles level. We talk about the intermediaries from the starting point, which is the customer, the broker, the exchange, clearinghouse, and custodian. And I think it's very important that you and your colleagues think about that existing market structure as you start to develop a framework for digital assets. And I do believe very strongly in an arena that is essentially a regulatory vacuum. A market structure bill will go very far in disincentivizing bad conduct and bad activity and create a much more transparent market where there certainly will continue to be fraud and manipulation. We see that in our regulated markets, but a much more powerful set of regulators and deterrents for bad actors so that we can have transparent markets and ultimately, as we heard from the other panelists, give the innovators, entrepreneurs an opportunity to grow in a jurisdiction where they know there are clear rules of the road.
Thank you. My next question is going to be focused on Mr. Xethalis and Mr. VanGrack. And I want you to talk to us about common themes in the regulatory frameworks associated with how to determine what is a security and what is a commodity.
Thank you very much for the question, Senator. I believe, generally speaking, when we ask this question, first, as a general principle, we must start that digital assets themselves are not typically securities. They typically are fungible, intangible commodities. Some can be designed to be non-fungible, but generally speaking, when we're talking about these, they're fungible, intangible digital assets. And in most cases, those digital assets do not represent a claim against a third party or a right that can be exercised against a third party. And under those circumstances, we can look at those tokens and say these look more like a standard commodity. Now, this is a technological innovation that can be designed in many different ways, and there certainly are tokens that can be designed to have a right that might be associated with a traditional security. A good example of this would be BlackRock's BUIDL fund, which tokenizes an instrument, and there you can tokenize just about any type of security that you want. But the typical digital asset that we're talking about is something that doesn't reflect, again, a right or claim against a third party, but instead a technological tool that can grant certain powers or access within a blockchain network or a distributed application. Now, when we're looking at the inherent securities characteristics of a token itself, we also have to understand that we have to look at the transaction around those tokens and whether or not the transaction around a token is a securities transaction. That has been the issue that we have struggled with as an industry and focused on the now infamous Howey test.
And when I used to go around and round with Gary Gensler on this issue, one of the things I know he was concerned about was using a tokenized security to try to get around some of the existing disclosure requirements for traditional securities. And so could you fold that in, Mr. VanGrack, into your response as well?
Absolutely, Senator. Thank you for that question, and thank you for all the work you have done on this committee and beyond for years with Lummis Gillibrand and the principles that you and your staff and others on this committee have worked on. You've meaningfully advanced the conversation and the ball on this absolutely critical issue. I start from the premise, Senator, that securities laws should only be applying to securities. And the fundamental challenge with that question you just asked is a tokenized security should potentially have the securities law apply to it. That is not a loophole, that is not a problem, that is not in dispute. The problem, which the SEC belatedly conceded after the courts weighed in, is that there's nothing inherent about a digital asset that makes it a security. It is only if that digital asset is part of a transaction that has the indicia of a security, like certain obligations and rights, that you are in the purview potentially of the securities laws. I don't mean to undermine it, but it's actually not that complicated. What has happened is the failure to define some of these rules and regulations has allowed uncertainty to become more pervasive, has allowed others at the federal and state level to kind of take over, I think, what is ultimately the prerogative of this Congress, which is establishing that clear legislative framework. And so at the end of the day, these issues are important, but they are not impossible or intractable. And I think the principles that you outlined are a very meaningful and important step in getting this right.
Thank you. And I feel like a kid in a candy store because I've had all four of you to myself, but I am going to defer for a moment to the father of the Genius Act, Senator Haggerty, for 5 minutes.
Thank you, Chairman Lummis. I appreciate that. And thank you for holding this hearing. And to all of our participants today, thank you for being here, as well as some great friends I see in the audience as well. Also, Chairman, I just want to thank you for your commitment to providing clarity for digital assets. You've done a remarkable job in leading not only on a national level, but I think on an international level to bring clarity to an asset class that is absolutely critical. If you think about the priorities that you've established, I think those served as guiding principles for the Genius Act that we just passed here to provide a regulatory framework for payment stablecoins. If you think about the momentum that we've established with passage of the Genius Act, you think about it coming out of this committee initially and then through the full Senate last week. I'm very encouraged that we've been able to generate bipartisan cooperation to work out a framework for digital asset market structure. If you think about it, for too long, the lack of clear definitions, clear jurisdiction, and navigable pathways for registration have forced digital asset innovation beyond our borders, jeopardizing our nation's financial leadership and putting American consumers at risk. It's also left a chilling effect on investment and a regulatory vacuum that was filled by the SEC's, quote, regulation by enforcement approach. And that approach had an extraordinarily chilling effect on the development of this marketplace. So I'd like to start with you, Mr. VanGrack. If you think about where you were under that approach of regulation by enforcement, You had to guess whether the SEC would deem a particular product security based solely on clues from what other digital asset related cases you might have been informed of, et cetera. And as a result, I feel like you faced, Wells notices, you faced lawsuits, you faced investigations. You didn't know what was going to hit you next. And in your experience, what was the impact of this lack of regulatory clarity on the ability of firms to actually operate and innovate here in the United States?
Thank you for that important question, Senator, and thank you for your leadership with respect to stablecoins and on this important issue as well. The short answer is it was devastating across the board. Right? Regulatory clarity, it empowers innovators, it protects customers, and it allows America to lead on these important issues. I think there are two important tensions here. First, America kind of seeded jobs in innovation and leadership abroad. America should be setting the standard, and instead it was following. Mm-hmm. The second observation is that in the aftermath of not having clarity at the federal level and not having that robust framework, you led with a patchwork of states trying to kind of usurp federal authority, and you end up with inconsistent rules, some of which directly conflict with what the federal government has said are the securities laws.
Yeah. Mr. Xethalis, can I turn to you? It's good to see you here today. And just continuing on this format, if you think about jurisdictional authority for digital assets and the lack of clarity there, I mean, how important is it when you think about making investments here in America, developing products here in America, to have clear jurisdictional authority established?
Well, thank you very much for the question, Senator. I think I and our colleagues and counterparts in the venture capital and asset allocation space, again, see this concept of an invisible tax not only on builders in this country who have to pay, again, for compliance and legal costs because we allow this industry to remain so uncertain, but also from an asset allocator perspective. We too saw the burden of regulatory inquiries and have to make an assessment when allocating capital in our risk assessment of the costs of a lack of clear rules of the road in the United States. And as I mentioned in my written testimony, we've seen not only developers migrate from the U.S. to abroad, but we've also seen capital flows move from the United States to offshore jurisdictions. And that's not effective. It hampers growth. It does wonders for law firm partner profits, but I'm no longer a partner at a law firm.
One more quick question before my time comes to an end. If you just think about the factors that should be considered when you're trying to determine jurisdiction, whether it be the SEC or the CFTC, could you run through a list of factors that come to mind for you that we should be considering?
Well, I think the first foundational principle is, are we dealing with something that is a security, a tokenized instrument? And that's table stakes. Mm-hmm. Again, as Mr. VanGrack said, if something is a security, putting it on a blockchain does not change that aspect. But then what we really are looking about is the context of the transaction. And I think in most instances, outside of the activities of, for example, when Multicoin is wearing our venture capital hat and are investing in builders who are going to take capital in a fundraising context and use it to develop systems, yes, that is a securities transaction. Now, the tokens that might be issued or the digital assets that might be issued down the road by virtue of that investment are not necessarily themselves securities, and they're not necessarily going to trade in secondary markets as securities. So we need to develop a clear line, clear guidelines, and a clear fine-tuned distinction between what is a commodity and what is a security, assign appropriate regulatory jurisdiction, and yes, we will find some areas that approach that line and have a hopefully shrinking gray zone where there is a lack of clarity and engagement with regulators and lawyers and policy folks will do wonders towards finding solutions there. But what we really should be gunning for is getting 95% of this market not needing to get a law firm opinion to launch a business.
Yeah, that type of clarity will be invaluable. Madam Chair, thank you very much.
Thanks very much. The chair recognizes Mr. Marino, followed by Senator Brooks.
Hold on. Thank you, Madam Chairman, for putting together this hearing. I'll start with you, Mrs. Hammer. why has this become partisan? In other words, we're talking about innovation. I don't think there was hearings about the Sears catalog going digital or Blockbuster Video becoming Netflix. Why all of a sudden has this become so partisan for some reason?
Thank you very much for that thoughtful question, Senator. From my perspective, this is not at all a partisan issue. I have been in the financial sector and the legal and regulatory space for more than 25 years, and I became interested originally in blockchain technology and digital assets because of my experience as a trader and portfolio manager. And recognizing the propensity for blockchain and digital assets to bring the attributes of decentralization, transparency, and immutability to our financial sector. That could reduce risk, that could increase financial inclusion, and it can increase efficiencies. And I believe that the best approach to digital asset regulation is one which recognizes our values, our American leadership, and the importance of having a clear regulatory framework that promotes innovation and protects us from malfeasance. I don't at all see this as a bipartisan issue. I see it as an issue which could support American entrepreneurs using digital assets for things from managing their personal energy-related data to increasing the ability to make cross-border payments, and to those who are using digital assets, even for things like healthcare, supply chain management. In my experience at the Wharton School, working with our Emerging Technology Accelerator, I've had the great privilege of working with entrepreneurs who are looking at many of these very interesting use cases. And students are great and talented students who are excited, who are innovating, and who are building companies in the digital asset space. And they are looking for a clear regulatory framework. On that count, I think the United States is a great leader in innovation and in thinking about how this technology can benefit. But on the other counts of having a regulatory framework at all, enshrining our values in statute, and also in terms of our growing our lead in the digital asset space, whereas once in 2021 and 2022, by usage, transaction volume, the United States was by far the world leader.
Would you say part of that is that we got scared? Like at the end of the day, America's always been about fearlessness and bravery. I mean, you think about, we're sitting here and I'm not trying to be funny, a literal swamp, and any proof, just walk outside. And we had people who lived here who said, hey, we're going to go west. And imagine what it would have been like 200 years ago to get from Washington, D.C. to Ohio, for example. It's certainly not a 45-minute flight on American Airlines. It took enormous bravery, leadership to say, hey, we're not going to fear the unknown. But it seems like what's holding us back at the big picture here is just genuine fear. And I think the fear is grounded in Xethalis? Yeah, Latino and Greek names are not combined, so my brain doesn't process your name, but I'm going to call you Greg. Greg, part of it is, like, I think we've just been paralyzed by this idea that the financial system isn't working for Gen Z and younger demographics that are upcoming. I mean, I think those of us who are Gen X, maybe older, tolerate the existing financial system because it's what we've known. But I think in 10 years, when you explain to somebody, hey, that you used to take a physical piece of paper, write a bunch of fancy things on there, sign it, and then you'd mail it to somebody, they would open it, they'd take that physical piece of paper, drop it off at some, what looked to be a retail stop, and then that money got transferred at some point, that our kids would be, come on, it's like saying that you had to go to school in the snow uphill both directions. I mean, it just doesn't make sense. So the financial system today is just not working. It's completely stagnated. And what I hope, I guess, as we talk through this, Madam Chairman, is that we can't lead through fear. Because if we lead through fear, we're going to be Europe. And something you said, Mrs. Hammer, which killed me, is the idea that the EU has caught up to us. I mean, when you think about bravery, boldness, and fearlessness, those are not the attributes that you'd unfortunately attribute to Western Europe today. So I just challenge this committee that when we're thinking about this regulation, that we understand the system is inevitably going to change. The system that exists today will not be that system. And what we have to do is chart a bold course and I know I'm out of time, I'm just going to throw some quick thoughts here. We need clarity, we need fairness, we need to make certain that the standards are achievable, and we need to make certain that we understand the current system is not perfect. And what we're building is a better system, but not a perfect system. Because if building a perfect system is our standard, then we will never get things done, and we will lose this. We want America to lead. We want America to be at the cutting edge of this technology, but we have to do it with total and complete understanding and humility, honestly, that the system cannot be perfect. I know I went over time, but thank you, Madam Chairman. I look forward to working on this going forward.
Well, I love it when someone who draws his roots from South America is the one who draws attention to the fact that it is American ingenuity and fearlessness that has brought us here. And for those of us who draw our roots from Europe, we're looking the wrong direction for guidance. Thank you. And Ms. Alsobrooks, you are recognized.
Thank you so much, Madam Chair. I want to thank Senator Lummis for hosting this important subcommittee hearing, along with Senator Gallego, who is out on paternity leave right now, but really he's played such an important role as well in this discussion. I've enjoyed working with both of them and their staffs on the Genius Act, and I'm really proud of our progress, and so I look forward to building on that partnership as we consider market structure. Also want to say thank you to each of the witnesses for being here today. I have a couple of questions for Mr. Behnam and Ms. Hammer. Thank you both for your service to our country. And what we know is that more and more Americans, including and most especially the next generation, view the broader digital asset market as a genuine opportunity to build wealth and create jobs. So I'm learning about real-world cases every day. I have to tell you, for example, the city of Baltimore used blockchain technology to create a centralized information database that made it easier to identify vacant housing lots. So during your careers in government and academia, I know that you've both had unique opportunities to learn about these technologies and assess their real-world impacts. And so my first question for both of you is, when you consider the wide range of digital asset technologies, which do you believe can provide the most tangible benefits to Americans, and do any examples in particular come to mind?
Thank you, Senator, for that question. I'm so grateful to have the opportunity to talk about the innovation and some of the use cases that I've had the privilege of working with. I lead an emerging technology accelerator at the Wharton School called Cypher Accelerator, and it was founded as a blockchain-based accelerator and now is open to any emerging technology startup anywhere in the world. And working with a tremendous group of students, dedicated, hardworking, brilliant, and far ahead in terms of thinking and innovation, we've had the privilege of working with startups, for example, using blockchain technology to manage supply chain in healthcare. So I mentioned this earlier, but for example, in the area of surgical devices, traditional methods of tracking surgical devices are inefficient and unreliable, which is a problem for compliance. Using distributed ledger technology, blockchain technology, a startup that we worked with is able to create a system for tracking supply chain management in surgical devices, thereby increasing efficiency and creating an immutable record that will better enable hospitals to do compliance reporting. That's just one example. I've seen startups that use blockchain technology for managing energy data to increase efficiency, especially after the pandemic when occupancy rates in buildings changed. I've seen startups looking at tokenization for real-world assets in order to provide access to certain assets to a broader population. There are so many interesting use cases, Senator. Another one which is very striking to me is the use of stable coins. We worked with a nonprofit organization that was implementing stable coins for individuals who were repatriating after the pandemic started. And those individuals did not have access to traditional financial services. By learning how to use their mobile device to use digital assets to make payments, to take care of their loved ones, and even to start small businesses. That use case really struck us, and it was a great privilege to learn more about it. Those are just a few of the use cases that I believe had great promise. There are many more that we haven't even imagined yet. And I look forward to the opportunity to see that innovation fostered in the U.S. as we move towards a clearer regulatory framework.
Thank you. And I see my time is tolling. So, Mr. Behnam, I just have a quick question. From your perspective as a former regulator, what are the most essential consumer protection components that you believe must be a part of market structure legislation?
Senator, thanks for the question. I would say there are several for sure, but I think the number one issue in terms of customer protections, specifically as it relates to digital assets, has to be around bankruptcy protection. And essentially, as we look at traditional markets, and as the former chair of the CFTC, knowing the customer segregation rules that the CFTC has, it's extremely important, given the current market structure of some digital asset exchanges and intermediaries, that customer assets are fully segregated so that if you do have a situation where there is a bankruptcy, there is no question from the first minute that the bankruptcy starts, the customer assets will be returned to the customer and not a part of the larger intermediary's assets.
Thank you so much. Thank you, Chair.
Thanks for asking it. The gentleman from Pennsylvania, Mr. McCormick, is next.
Thank you, Madam Chairwoman. Thank you for holding this hearing. I'm going to ask a series of quick questions, so if I could just get quick responses to you, I'll try to make the most of my 5 minutes. First, providing the rules of the road will give innovators and entrepreneurs the opportunity to invest in growing businesses. And this obviously attracts investment from around the world in cutting-edge innovation. Ms. Hammer, could you describe what you're seeing in the venture capital industry as it applies to digital assets?
Yes, thank you so much, Senator McCormick, for that question. Through our work with an accelerator at Wharton, we do work very closely with the venture capital industry and very insightful, successful venture investors who evaluate the startups that we work with and have a rigorous set of criteria. I would say it's become more difficult for those investors to invest in digital asset businesses. When there isn't regulatory clarity, investors cannot know if their investment will be sound over the long term. And so I think that providing that regulatory clarity is absolutely essential to promoting venture investment here in America.
Great, thank you. And Mr. Behnam, the emerging area of tokenization of real-world assets, commodities, equities, deposits, could bring real operational efficiencies, increased transparency, and real-time data. Could you highlight the legal considerations that traditional financial institutions face in exploring blockchain technology, specifically as it relates to tokenization?
Thanks, Senator. One, there's significant operational risks that I don't think necessarily exist in traditional markets that would have to be thought about, not insurmountable, but certainly an issue of sort of first concern and first impression for the entities. I also think, as Mr. VanGrack said earlier in a conversation and in response, these are important questions to think about how tokenization of real-world assets will impact existing commodity laws and security laws. And I'm not suggesting that they will absolutely undermine them or that there's not a sufficient way to ensure that the existing laws are preserved. But I do think that there are potentially ways, if not done correctly, and that's why a market structure bill is important, is that we preserve and do not undermine existing securities laws or commodity laws as we see assets more frequently tokenized, because it's going to provide more access for users and customers. And as you suggested, better ways to move assets around and across different portfolios, but we have to be very careful about how we approach it from a regulatory and customer protection standpoint.
Very good, thank you. Mr. VanGrack, as we stand up a new regulatory regime for innovative firms, attempting to register with the SEC and the CFTC, it's a massive undertaking, as you know. How should we balance creating new pathways to register new firms with ensuring that the existing SEC and CFTC registered entities are able to enter the digital asset ecosystem with as little friction as possible?
Thank you for that question, Senator. It's an important one because inherently the industry and Coinbase specifically has been seeking that very clarification, right? Which is the clarity. With regulatory clarity comes regulatory risk. Companies want to know how to comply with the laws, and investors want to know that those laws are being complied with. 3 years ago, we asked, in fact, begged the SEC to promulgate rules and regulations, but rather than getting rules and regulations, we got subpoenas and a Wells notice. That has it backwards, and I say that as a former enforcement lawyer at the SEC. You have to first develop the rules and regulations before you enforce them. But Senator, what I think is important here is those pathways are not unique questions to ask, right? Both the SEC and the CFTC, under the leadership of Chair Behnam, have in other spaces and other arenas found ways to create this balance, not just independently, but in areas like swaps, you have an ecosystem where both of these commissions have a role to play. And I guess the short answer is that is the exact question to ask, but it is not an intractable one to resolve through market structure legislation.
You know, just in the remaining time I have, if you were going to think about principles that should guide the design of such pathways, is there a couple key principles you want to suggest to the committee?
Yeah, without using profanity, the KISS method, right? You got to keep it simple. At the end of the day, complexity sucks the life out of innovation. The last 4 years has been a boondoggle for lawyers, and it has harmed innovators and customers. I think as simple as possible should be the mantra that keeps us on the right path.
Very good, thank you.
Questions. I have at least one more question, and I know you do too. Do you have another? No. Okay. So we're going to do a second round, but I'm going to ask us to go with one until these people are exhausted.
They're exhausted.
Exactly. Self-regulatory organizations. Mr. Behnam, can you explain how they work and how they benefit the organization?
Thanks, Senator. Important question, something I mentioned in my statement. They are partners of regulators. They are also partners of the private industry. They are often sort of quasi-public-private organizations. But as chair of the CFTC, you know, a large organization, but not huge, and we certainly didn't have the capacity to oversee the entire commodity derivatives markets. We lean on, and the agency, leans on the National Futures Association critically to handle a lot of the work, sort of boots on the ground, for introducing broker, associated persons, swap dealers, FCMs. They are a partner by statute, and the same is the case with FINRA and the SEC under the securities laws. And they are extremely important from an enforcement perspective. They are extremely important from an exams perspective and a supervision perspective, and just understanding what the market is. And I think that is by proxy a product of the fact that there's a limitation to what a federal agency can do. And I don't think we want the federal agencies to get too big, but it is a partnership where you have an acute expertise that isn't somewhat unique from the agency and is more integrated into the day-to-day operations of the market and is a support. They are a partner above all else. I had a fantastic experience with the National Futures Association. I have a very close relationship with FINRA, and I felt like as a regulator, and I know the SEC feels the same, it's critically important to have those SROs around to succeed. And I would think, as I said in my statement, as you think about a market structure bill, having an SRO a part of this effort is going to be critically important.
And so the next question that I have is going to be, where do we put it? Because we've got both SEC and CFTC jurisdiction here. But the question is now yours, Mr. Marino.
Well, thank you. So I'll ask you to each answer this as briefly as humanly possible. So try not to have your inner senator come out. So how much time do we have to regain leadership in America? and what's the price of failure in your mind? Start with Mrs. Hammer, go down the line.
Thank you, Senator. We need to act now. I believe that the U.S. is far behind other jurisdictions in terms of enacting a regulatory framework. And as my data shows in the written testimony, while we have had a lead in digital assets, others are rapidly catching up to us and perfectly poised to surpass us. We have to act now.
And what's the price of failure? Like, what does failure look like if we don't do anything, if we get mired in inaction?
Thank you, Senator. The price of failure is that we will have criminal activity, illicit activity in digital assets, fraud. We will have a more difficult time enforcing our rules and regulations, and we will have expensive, costly, time-consuming regulation by enforcement.
Thank you for the question, Senator. Not surprisingly, I also agree that the time to act is now. And I would say that there are two significant costs that come from not acting now. As Ms. Hammer has pointed out, other jurisdictions are acting. And we saw the cost of that in global data protection, where more onerous rules coming from Europe and the GDPR regime have created, frankly, problems and liability concerns for internet commerce more broadly. We don't want the same thing to happen with the digital asset ecosystem. We want the rules to be created and be imbued with the DNA of American commercial practice, legal practice, and policy focus. The second cost is the economic one. And ownership of technology has been the great hallmark of America in the 20th century and the initial part of the 21st century. It was from the steam engine to the internet, but we faltered in the last 10 years. We've been behind on technologies like 5G. We've lost our silicon manufacturing capability, which started here and migrated abroad. We do not want to do the same with the next generation of the internet that has the possibility to transform not just financial transactions, but consumer transactions and how information flows.
Senator, for the sake of being brief, I'm not going to repeat some of the consequences, but I will disagree respectfully with my fellow panelists. The time to act was yesterday, right? This technology was founded over 16 years ago. And here we are nearly 2 decades later, where the industry is asking for rules and regulation. That is not unique. That is unprecedented in our founding, in our country. So in that interim, you've had investors lacking the full suite of protections. You've had innovators struggling to understand the rules of the road. And if they're not moving abroad, they are hiring armies of lawyers to try to understand what the rules are, or facing, like Coinbase did, spurious lawsuits to defend themselves against rules and regulations that have never been promulgated in the first instance. So I think the consequences are devastating, and I do not think we have any time to wait.
Senator, I'll take you down the regulator's point of view. I think I was a commissioner in the first Trump administration. I think wrote an op-ed in 2018 or 2019 saying we needed, a change in statute. And that was by virtue of the observations I had made at the commission back then, and then as chair in the Biden administration. Obviously, we heard about the entrepreneurial, innovative side, but from a regulatory enforcement standpoint, too much fraud, too much manipulation out there, constituents across the country getting hurt. I think in our fiscal year 2024 enforcement program, the CFTC's enforcement docket, 50% of it, near 50% of it was crypto related, which is an astonishing number for a market that the agency doesn't regulate. So gives you some sense of how much fraud is potentially going out there that the agency is just unable to identify or see because there's no traditional regulatory authority. So certainly the time to act is now.
So, Madam Chairman, I wanted that on the record. If we could see if it's possible for that transcript to get distributed to all the members of the Banking Committee, because this is a completely bipartisan point of view. There's no dispute that we squandered the last 4 years in not acting. And because we did that, we're now behind the 8 ball. And I know this place doesn't operate exactly in the speedy way. This is not the Chick-fil-A drive-through. But we do have a responsibility for this country, because the actions that we're taking right now will affect future generations and future technologies. And believe it or not, that's my last question. Thank you.
Thank you. I want to thank our witnesses. I do want to explore your thoughts about ancillary assets and about self-regulatory organizations, where you put them between the SEC and the CFTC. So I would ask you, if you have thoughts about that, please submit them in writing or call me personally, because we want to make sure that when we put a piece of legislation out, it incorporates some of the great thinking and experience of those of you who have been very boots on the ground in this area. I further want to invite you to make sure that we continue to have a bipartisan discussion. I know there's a lot of competing committees this afternoon and hearings and places people need to be, but I don't want to come up with a piece of legislation that the other side of the aisle feels they haven't had adequate input in. And so that is going to require maybe me to go out of my way to pursue additional discussions directly with the other side of the aisle. But I hope you will too, because you heard Senator Marino's question about why has this become partisan. I'm scratching my head about that too, because it was never that way during the 4 years that I was working under the Biden administration's leadership with Senator Gillibrand. It was very bipartisan then, and now it seems not to be, and I don't understand what's changed, at least with regard to this topic. Now, I understand what happens when you have a set of leaders that are not engaged in digital assets, and then in comes an administration that has family members that are engaged in digital assets. And maybe that's what this is about. Maybe this is about concern that certain people that have family members in the administration are going to be advantaged in some way by what we're doing. I don't want that to be the case. I want everybody to be advantaged. I don't care what your politics is. If you're an American and you want to lead and innovative in this space, I don't care what your politics is. So, yeah, sir? Are you guys taking questions? I have a question. But I'm going to close the formal part of the hearing right now, and then I'm going to let you ask your question, okay? Okay, so let me just announce that the formal part of the hearing is over, and I appreciate very much the attention and the expert testimony of our witnesses. And with that, I'm going to close the hearing.